Hello everyone, and welcome to today's webinar, Harnessing the Power of Factors, Metrics for Success in Minimum Volatility and Multi-Factor Strategies. I'm John Swolz, and I'm the Director of Content here at Inside ETFs and your host for today's webinar. Before we begin, I want to just cover a few housekeeping items. At the bottom of your audience console are multiple application widgets you can use. If you have any questions during the webcast, you can click on the Q&A widget at the bottom and submit your question. We will try to answer them live during the webcast, but if a fuller answer is needed or we run out of time, our speakers and sponsors will do their best to follow up. We capture all of the questions. If you're looking to expand your slide area, you can do so by clicking on the Maximize icon on the top right of the slide area or by dragging the bottom right corner of the slide area. Should you have any technical difficulty, please click the Help widget. It has a question mark icon and covers most of the common technical issues. An on-demand version of today's webcast will be available approximately 1 day after the conclusion of today's webinar and can be accessed using the same audience link that was sent to you earlier today. Now, on to our webinar. I'm pleased to be joined by Holly Fromstad. Holly is an investment strategist with iShares by BlackRock. I was talking with Holly a little bit earlier, and I know she has a lot to cover, so we want to go ahead and get started. Holly, why don't you take it away?
Thank you so much, John. On behalf of iShares by BlackRock, I'd like to thank everyone on the line for dialing in today. Smart beta is certainly a growing topic of interest in the investment community, and particularly among financial advisors. So I'm happy for the opportunity to share BlackRock's thoughts on this new and growing landscape.
Holly, with that in mind, why don't we go ahead and kind of kick things off today by setting the stage. Why smart beta? Why now? Do you really think it's here to stay, or is it just a flashy trend?
Yeah, absolutely. We definitely think that smart beta is more than a fad or simply a passing trend. It's fundamentally reshaping how our clients think about portfolio construction and diversification. With the Department of Labor regulations, disclosure requirements, and a move toward the fiduciary standard, we believe there will be fee compression in the industry, and that will mean over time that low-cost, scaled exposures gain prominence in advisory portfolios. This means that as asset managers and fund providers, we, being BlackRock, need to think differently about how we deliver exposures to our clients. Now, traditionally, investors had to make two choices at once when they were picking a fund: cost and exposure. So how much were they willing to spend on a particular product, and what was the outcome they were trying to solve for? Historically, where they wanted low cost, the exposure had to be the market, or beta. And where they wanted something other than the market, if they were looking for alpha or outperformance, it came at a high price through active management. However, what we know is that when we think about active management, most large cap active managers don't do fundamental analysis on all 500 stocks in the S&P 500, for example. They use intuitive screens to reach a subset of securities that they're going to look into further. Those screens alone used to be really difficult to achieve and were worth a higher price on their own. However, technological innovation over the last few years has dramatically improved the screening process, bringing efficiency up and costs down. Now, what this means is that we're now seeing a rise of a hybrid breed of investment products that leverage scaled, low-cost screens to deliver on exposures that can provide alpha in a portfolio. So smart beta is basically combining some of the best of both beta and alpha, active and passive exposures, by delivering in a very low-cost, transparent form exposure to sources of risk and return that were previously only available at a really high price. Now, this is not to say that market cap-weighted exposure is somehow insufficient in a portfolio. The long-run return on U.S. markets has been robust, and it involves investing in logical bellwether firms that we're all familiar with in our day-to-day. However, we can see here that there have been significant periods of drawdown during this time horizon. I know that most of us on this line have probably experienced many of these in our own investing horizons. And forward projections for equity market returns today are not in the robust double-digit range. Increasingly, clients are concerned about cost, and they're concerned about whether their exposure is designed to meet their specific investment needs. And so smart beta allows them an opportunity to separate these two decisions. in a low-cost manner. So if we take cost off the table, clients can now choose from a number of different outcomes, like getting the market, reducing risk, or enhancing returns. And increasingly, we see clients making a distinction about where they want to be risk off versus where they want to be risk on in their equity allocations around the globe. So our product set gives investors the tools to do just that by differentiating between domestic and international exposures.
Thanks so much for that, Holly. That makes a lot of sense. Many of these new products, they invest in things that are called factors. Can you help explain what factors are and why they're an important part of smart beta exposure?
Yes, absolutely. Factors are certainly an important thing to address here when we're talking about what is smart beta and defining what it can do in a portfolio. And as a term, it can be kind of confusing. And I know particularly as you're trying to relay this concept to your end clients. Factors are to investments what nutrients are to food. Each piece of food that we eat contains many nutrients, some of which are better for you than others. And smart beta investing is like a refined diet for your portfolio. So just like you may want to increase exposure to protein to build lean muscle or emphasize leafy greens to slim down, you might change your factor exposures to isolate drivers of risk and return in your portfolio that make you more likely to achieve a particular outcome. Some factors can help drive better returns than the market. Others help reduce risk. But just like the fact that a diet should be well curated and well balanced, the factor exposures in your portfolio should be diversified and balanced as well. Now, there are 5 commonly agreed upon factors that have a long history of research that shows that they have and can add value in a portfolio. And you see that those 5 on the screen right now. Minimum volatility is exposure to less risky stocks. And it adds value in a portfolio and can improve portfolio efficiency, specifically by delivering market-like returns with less risk over time. So it tends to drive greater efficiency by reducing risk as opposed to improving returns in an absolute sense. The other 4 factors have historically added value by improving returns. Quality investing identifies companies with strong balance sheets. Value investing buys companies that are priced below their fundamental value. Momentum invests in price trends, so it identifies stocks that are on a trending streak, an upward trending streak in the market. And size investing invests in smaller capitalization securities. These concepts, though, are not just vague, intangible theories. You can create very concrete and intuitive screens to identify stocks with particular factor characteristics. So as an example of this, identifying value stocks based on price multiples or quality stocks based on the stability and consistency of their earnings over time. These screens have long been utilized by active managers, and smart beta simply leverages that concept to deliver in a low-cost fashion exposure to these beneficial tilts in a portfolio.
Thank you for that, Holly. I know one of the things that we're hearing a lot about now is that these strategies can get very crowded or could become crowded, and you've kind of given us a formula here. So if everyone was to go out and kind of buy on this recipe, won't all the value add or alpha sort of disappear or go away?
Yeah, absolutely. That's a question I get a lot, and I think it's important to understand how we define a smart beta factor and what goes into that. At BlackRock, in order to call something a smart beta, we need to understand what we call the economic rationale behind that factor's performance over time. Specifically, we want to understand why it has performed well in the past so that we can ensure that there is a reason to believe that that factor will continue to perform well into the future. All 5 of these factors capitalize on either a structural impediment, a behavioral anomaly, or they reward you for risk that you're taking. Now, let's look at value as an example. Value investing has worked for 2 main reasons. The first reason is it's rewarding you for risk. The value firms with higher fixed costs are riskier because they're less flexible than growth firms over time. Many traditional value firms are service or manufacturing companies. When the economy slows, they're stuck with very specialized equipment that can't be easily repurposed. In contrast, growth firms can quickly pivot their business models. Investors should earn a premium over time for owning value companies because they are owning that less flexible business model. So I think of a car manufacturer here, where if you have a plant that is set up to create one very specific thing. If people stop buying cars because the economy goes into a recession, then as the car manufacturer, you just have to wait that out because people will start buying cars again at some point. And so that's an example of a value investment where there's an inflexible business model built in. Now, second to rewarding for you for risk, value investing also capitalizes on behavioral bias. So oftentimes investors make the mistake of projecting past performance into the future. What this means is that they leave value stocks undervalued. So investors are dazzled by stocks with high past growth or past high growth rates, and they naturally assume that these results can be extrapolated into the future. And when expectations fall short, growth companies flop, which tends to leave value firms on top. Now, this is just one example. Every one of these factors has a similar rationale behind why we believe it will continue to perform well into the future.
Makes sense to me. Holly, I think I saw somewhere that BlackRock estimates investors have moved somewhere around $11 billion into minimum volatility investments this year. Can you tell us some more about these strategies and won't they limit your returns in the future?
Yeah, so that's a really common misconception about min-vol, so I'm really glad that you brought it up. And the idea behind minimum volatility and really the answer to your question is a little bit counterintuitive. So minimum volatility investing is for the client who is concerned about risk reduction as a primary objective. These strategies help you move west on this risk and return plot by attempting to deliver market-like returns with lower risk over time. Min-vol has worked and has the potential to improve investor outcomes over time really for two reasons. The first reason is behavioral. So we're all probably familiar with this Dalbar study, which highlights the differences between investment returns and the typical investor returns. By not sticking to an asset allocation over time, and by making emotional decisions about when to be risk on and risk off, when to take money off the table or plug more money into your investments, investors tend to leave money on the table. By minimizing the swings in your client portfolios, you can help them stay true to their asset allocation longer and potentially improve their investment results, taking them closer to the investment results of a 60-40 portfolio over time. Now, in addition to helping kind of solve some of the behavioral challenges of investing, the second reason that min-vol has historically worked is actually mathematical. So intuitively, and to John's question, many of you probably believe that full participation in the market will lead to better returns over time. However, if you look over bear and bull market cycles, so incorporating both a bull and a bear into this calculation, what you often find is that a capture ratio less than 100% can yield better investment results. So on this page, this is illustrated with a 75% capture ratio over the last bear and bull cycle. But you can see this play out over nearly every cycle. And it makes sense when you think about the old adage of if you lose 50% of your investment, markets have to rebound 100% to make your money back. So if you can limit your drawdowns in the portfolio, that can lead to better investment outcomes, even if participation is also limited on the upside. So in aggregate, it won't necessarily cap your upside. Now, our minimum volatility suite of products is designed to mitigate risk. It's designed to protect you when markets are at their worst. And it's resulted actually in a capture ratio that is asymmetric over time. So what I mean by this is that our funds have captured, on average, about 80% of the positive moves in the market, while only participating in about 60% of market drawdowns. For me, though, this asymmetry is important, but the proof is really in the pudding, or the data, if you will. So what have investors actually experienced? How have these indexes performed? Minimum volatility is designed to reduce risk, and ideally, it can protect you during market dislocation. The track record for the index that our fund tracks or replicates can be seen here. So the green line on the screen represents the VIX, a measure of implied market volatility. And the blue bars represent the relative performance of the MSCI USA Minimum Volatility Index versus the rest of the market. So when did it beat the market? When did it underperform the market? What you can see is that in each instance of increased volatility in the market, including last August and the beginning of 2016, the minimum volatility strategy has outperformed the market. But most cases, and this is a matter of falling less when the markets are down, right? It's not necessarily generating positive returns over time, but the effectiveness of the strategy to perform when volatility spikes has been proven over many cycles. And as we already talked through on the prior slide, mitigating drawdowns can actually improve investment results over time. In fact, what you see on this next page is a very clear pattern of underperformance versus the market when markets have rallied, and outperformance when markets have declined. So over time, this has resulted in stronger performance of the MSCI USA Minimum Volatility Index versus the market, despite a capture ratio that's less than 100%. Now, it's important to remember that min-vol investing is not about returns. It's about risk mitigation over time. During bull markets, min-vol can be expected to lag, with about 80% of the up capture in the market. But if held for long periods of time, the strategy has a higher likelihood of having a meaningful impact on portfolio efficiency. And what I mean by this is, if you look at the frequency of times that the min-vol index has historically underperformed the market when the market was down, so again, a kind of a counterintuitive result, you expect to do better than the market when the market is down. Holding period matters. If you're evaluating this strategy on a quarterly basis, in the last 16 years, the index has underperformed in 16% of down markets. If you extend your holding period to 1 year, this number is reduced to 10%. In 2 years, there's only 1 instance, and in 3 years, there have been no instances where the min-vol index has underperformed in a down market. So the point here is that you should be investing for the long term, and you should give this strategy time to work for you.
Holly, can I step in here real quick? I know min-vol strategies have certainly been in the news quite a bit, basically because of the strong performance and elevated valuations. But there's critics out there, and they contend that the trade is done and the strategy is going to lag going forward. So I have 2 questions for you here. What are your thoughts on the timing of the trade, and is it too late at this time?
Yeah, I'm glad you brought that up, John, because it certainly has been coming up in the news with increasing frequency. And honestly, I really think it's distracting investors from the true value in min-vol, which is to help reduce risk and mitigate drawdowns. This strategy is not about investment performance over time. It's about limiting your exposure to drawdowns so that over the long run, you can have a better aggregate investment result. So let's take a look at the truth behind the assertion that there's a relationship between valuations and future returns. And then let's take a look at whether valuations have any impact on the ability for min-vol to reduce risk in a portfolio. So first, I would agree that there is a historical correlation between the current PE of min-vol and subsequent future returns of that strategy. However, correlation is not causation. Minimum volatility intuitively tends to be priced more expensively than the markets when the markets have fallen and the strategy has fallen less. So when markets subsequently rebound, the strategy can lag. This is completely expected, not due to valuations, but due to the fact that the risk mitigation in the strategy means it generally will lag in a positively trending market. You know, we just looked over at time periods that illustrated a number of bears and bulls where in pretty much every case min-vol lags in a bear market or in a bull market. In fact, if you look at the green line on this page, it represents the PE premium or discount of min-vol versus the rest of the market. The yellow bars on this page represent the subsequent 3-year return on the market. So you're looking at a point-in-time PE, and then forward from that, what was the 3-year return on the market? What you can see is that much of the data that's available on the min-vol strategies has come at a time when equity markets have experienced trending strong returns. So it's no wonder that the strategy has lagged after valuations were high. It should only capture a fraction of that positive move anyway. I think that actually the more important metric to focus on here is the metric that really should be driving an investment decision in these products, risk reduction. Now, what you can see on this next page is, again, the PE premium or discount of min-vol versus the market. This time it's plotted with subsequent 3-year excess risk. And in all periods measured, min-vol has persisted in delivering lower risk than the market on a rolling 3-year basis, regardless of valuation. And we're choosing 3 years here simply because, as I illustrated a couple slides ago, holding period matters, and you really should be investing to give this strategy time to work. So do we think that these strategies are likely to lag the market going forward? Possibly. I would expect that they'll lag when U.S. markets stabilize and when they begin a steady upward trend. But in the meantime, if you think that volatility is here to stay and protection from drawdowns can help improve your clients' outcomes, then valuation should not impact the strategy's ability to reduce risk.
Awesome, thank you. We spent quite a bit of time here looking at minimum volatility strategies, and I appreciate the clarification on that. And there has been a ton of assets in those strategies, but we also see that there's been some product innovation in the multi-factor space. Can you walk us through a little bit about what factor funds are, how they work, where they can be used in a portfolio?
Yeah, happily. So factor-based investing, or this idea that you can invest to enhance returns, is the fastest growing area of ETF innovation in non-market cap weighted products. So it makes sense given today's investing backdrop. On the heels of challenging performance from active management, we've seen close to $1 trillion flow out of active products over the last decade. And much of those assets, we believe, are today invested in market cap weighted exposures. But in an environment where expected equity market returns are probably low single digits at best, and many investors are still looking for market-beating performance. They just want a lower price point and potentially greater predictability in delivering those results over time. Multi-factor strategies employ many of the same screens that active managers have used for decades to select stocks, and they deliver these exposures in diversified, low-cost, transparent packages. So I already described factors as nutrients for our investments. Let me dig a little bit deeper into why it's important to have diversification in factor exposures within a portfolio. What you can see on this page is an illustration of the economic cycle. Factors perform differently around the economic cycle. In the early stages of an economic upswing, I think of this as the boomerang effect, where pro-cyclical, higher beta investments like value and small cap will tend to outperform. They're capturing that economic uplift in performance more effectively than the other factors. In the middle stages of the cycle, markets become very consensus-driven, and momentum as a factor, which is really all about trending prices in the market, will come into favor. Finally, in the later stages of the cycle, consensus tends to break down, volatility picks up, and I think of this as a stock picker's market. In this market, an ability to truly identify companies with strong, stable earnings and robust revenue streams that will withstand the downturn effectively, what we would call quality investing, as a strategy that should win. So as you can see, at different stages of the cycle, different factors perform best. Now, across a full cycle, all four factors have historically added value. But if you're invested in a single factor, like value on its own, for example, you'll tend to see a lot of cyclicality and volatility in that performance. This next graphic illustrates the volatility of individual factors by showing the rolling one-year excess returns. Now, there's a lot of information on this slide, so I'm going to focus your attention on just a couple of the colors to illustrate the point. As you can see in the orange line, which represents value, value sometimes does really well, and sometimes it does quite poorly. There's a lot of noise in its quest to deliver results. On the other hand, the shaded blue area here represents a multi-factor approach. So this is an approach which combines all four factors, quality, value, momentum, and smaller capitalization stocks, together in one strategy. Now, you'll notice that this blue line, or this blue shaded area, may not be the best performing in every single period relative to single factors, but it is driving greater consistency and outperformance over time versus these indexes. With MinVol, we talked about that emotional aspect of investing and the fact that if you can smooth the ride for your clients, you can help keep them true to their asset allocation decisions and keep them invested longer. The same is true in multi-factor space. By diversifying across multiple factors at once, you can help smooth the ride versus a single factor strategy as you're seeking out performance. And this can help you help your clients stick with that investment decision longer. So really, the idea behind a multi-factor approach is to take the simple and intuitive screens that I mentioned at the beginning to identify stocks which are underpriced, higher quality, trending, or smaller in size, and combine those screens together to select securities within the portfolio.
Holly, let me jump in here real quickly because I think we're starting to get to kind of the heart of the webinar here. This makes a ton of sense. We've covered quite a bit. But I also know that it's very popular and we're seeing a lot of new entrants into this space. With so many choices out there, how should advisors be thinking about portfolio construction and due diligence? How do you kind of compare these strategies one against another?
Yeah, so this is a really important question, I think, because so often this concept of smart beta as a category becomes a catch-all. I really think it's, one or the other are completely interchangeable. Due diligence is incredibly important in outcome-oriented, non-market cap-weighted strategies. So just like you probably wouldn't randomly select a large cap value manager out of a hat thinking that they're all the same, you should really approach smart beta strategies with the same level of due diligence and scrutiny that you apply to active management today. Let me talk through how we've constructed our minimum volatility and multi-factor portfolios, and then I'll give you what we believe to be a pretty good framework for thinking about smart beta due diligence. Now, let's start with min-vol. The simplest way to construct a low beta portfolio is to simply purchase the least risky stocks. Re-rank the market based on volatility, buy those stocks that contribute the least amount of vol. It's simple to explain, it's intuitive, it gives you a result of a lower beta portfolio of securities. What happens if you do this, though, is that you end up with a portfolio that's very strongly overweight certain defensive sectors. It's also overweight defensive, more bond-like securities. And what we know is that most of our clients are interested in using min-vol at the core of their portfolios as a means to reduce risk and stay invested in the markets. If min-vol is replacing core equities for you, then that strategy needs to look like core equities, which means it probably shouldn't have a lot of exposure to excess drivers of risk and return, like single stock risk or strong sector tilts. For this reason, we've constructed our min-vol suite in a more thoughtful way, employing optimization so that we can deliver not just a portfolio of low beta stocks, but truly a low beta portfolio. Now, optimization is not a black box. It's really just a fancy way of saying we're letting a computer solve a math problem that is simple but complicated to execute longhand. Specifically, what we want the optimizer to deliver is a portfolio that minimizes risk, but that looks like the market. To do this, the optimizer analyzes the volatilities of individual securities, and it accounts for how those securities move relative to one another. Then it applies a series of constraints to get a portfolio that looks like the market. It constrains sectors to plus or minus 5% of that sector's market cap weighting. It constrains countries in international strategies to that same plus or minus 5%. And it also constrains individual security weights and risk factor exposures so that in the end you have a portfolio that is predominantly lower beta securities, but a portfolio will also allow for the inclusion of higher beta stocks to the extent that they're diversifying and can help contribute to sector, country, or risk factor balance. So you can see this is a more thoughtful than simply buying the least risky stocks because it results in a portfolio that can sit comfortably at the core of an investment strategy, given that it looks similar to the market across many other dimensions of risk and return. Now, our approach to multi-factor is much the same. The easiest way for us to construct a multi-factor exposure would be to simply stack together 4 single-factor funds or indexes and call it a day. In fact, we launched our single-factor suite of products before we launched our multi-factor suite. So that certainly would have been the easiest for BlackRock to create, is a fund of funds that had those 4 tickers in it. The challenge with doing this is that you'll likely invest in a large number of securities, and some stocks are going to dilute the factor exposures of other stocks. For example, if you buy a high momentum but low value stock in your momentum sleeve, and you buy a high value, low momentum stock in your value sleeve, when combined, those exposures effectively cancel each other out. And if this were your whole portfolio, you'd look like the market in factor space. As a result, we're more thoughtful in our approach, and we invest with the philosophy that the best way to achieve maximum return potential is to focus your investment in stocks that have multiple beneficial characteristics. Let me take this back to nutrients for a moment. So if you think eating a salad is a healthy option, would it be better to eat iceberg lettuce or spinach? Spinach packs a greater nutritional punch, just like buying a stock that is high quality, small cap, trending, and underpriced should pack a higher returns punch in a portfolio than a stock that only has one of these characteristics. Now, because of this, our approach to multi-factor is more thoughtful than simply stacking together 4 separate indices. Just like MinVol, we're using an index that employs an optimizer to construct the portfolio. In this case, we want to make the portfolio look like the market, but we want to maximize our exposure to securities with multiple beneficial characteristics. To accomplish this, MSCI, our index provider, assigns an alpha score to each stock. This alpha score is an equal weighted average of the stock's measure of quality, value, momentum, and size relative to the market. So stocks that have strong positive exposure in multiple of these 4 factors will have a higher alpha score and will be more likely to be included in the index, and when included, likely included at a higher weight. The optimizer's goal, in this case, is to maximize exposure to securities with high alpha scores while controlling for sector, country, and other risk factor exposures just like MinVol. In addition to that, risk is constrained to be in line with the market. We know that clients are holding multi-factor at the core of their portfolio as an opportunity to get market-like risk with potentially better returns. So we want this portfolio to look like the market. Now, in this sense, our MinVol and multi-factor portfolios are 2 sides of the same core coin. The decision is, where do you want to minimize risk versus where do you want to maximize returns? If your investment objectives are something other than market returns or market risk, then Smart Beta can offer a new twist on a core portfolio to help you achieve a specific outcome. Which really brings me back to that due diligence question. So if you think about Smart Beta like we do, as an allocation at the core of your portfolio designed to deliver a specific outcome, then you need to conduct due diligence with this lens in mind. Here we have a suggested framework for approaching due diligence in this space. First, what is the purpose of the investment strategy? And what factors is the fund trying to get exposure to? And are those exposures appropriate for the investment outcome you're seeking? An example of this is the inclusion of the MinVol factor within a multi-factor approach. Minimum volatility investing can be highly efficient as an investment strategy because it reduces risk. But with an 80% up capture in the market, it also theoretically can dampen returns when markets are doing well. Because the goal of our multi-factor strategies is outperformance, we specifically don't include MinVol in the selection criteria because we believe that it will simply result in capping returns potential over time. Now, the second thing to look for is the outcome that you're seeking. Specifically, does the funds that you're evaluating deliver on strong exposure to the desired factors, or is it delivering weak or diluted exposure? And is the strategy employing checks and balances or constraints to ensure that you have a resulting exposure that can sit nicely at the core of your portfolio? As we talked about, our funds all employ constraints so that it looks like the market and so that we are not diluting, or ideally diluting in as little as possible, the factor exposures over time. Finally, management matters, and so that should absolutely be considered in your decision to choose a provider. Can your provider deliver on the low cost, transparency, and tax efficiency that you have come to know and appreciate about the ETF structure, while also delivering best-in-class expertise in factor investing? As you can see here, there are many things to consider, and you can't easily gloss over the details in a Smart Beta strategy. But we think that this checklist gives a really solid and simple framework for evaluating providers in this diverse landscape.
Holly, that was quite a bit there, but extremely helpful. Now some of the challenges that we keep hearing is that investors don't know how to implement these factor strategies in their portfolios, right? There's a lot to cover there, and it's not as easy as one might think. Do you have any guidance, or is there anything you can do to help our attendees better understand how they can incorporate factors into a portfolio or building a diversified portfolio of stocks using Smart Beta exposure?
Yeah, I'm happy to help there because this is certainly a challenge that I hear about frequently when I'm out in the field meeting with clients on a daily basis. And because we hear this challenge so frequently, BlackRock has built a number of tools to help advisors work through really the three key challenges to implementing smart beta in a portfolio that we hear. First is education. What are factors? How do they perform? Can I play around with the data myself? The second is portfolio construction. So great, I love the story around factor investing or min-vol investing, but how does it fit in the portfolio and how can I think about it from a diversification standpoint? And then finally, and I think importantly not to be overlooked, is really addressing client concerns. And by that I mean your client's concerns. So how can you take a strategy that is not a market cap weighted strategy and explain it simply to your clients? We've built tools to help address these three concerns individually. So the first is our factor performance chart. The factor performance chart is designed to educate how factors perform at different stages of the economic cycle and during different market shocks. It allows you effectively to compare one factor versus another and to compare factors generally versus the market. The idea here is to illustrate factor performance in a manner that is very flexible and customizable to your specific questions and your specific needs. Now we're going to be loading a demo here. So what you can see is the factor performance chart. And across the top, you have an opportunity to select any number of factor indices. At this point, we're looking at U.S. exposures. At some point in the future, we'll likely include international as well. Now you can select benchmarks. The appropriate MSCI benchmark for the index that you select, the parent index, is automatically selected, but the S&P 500 is also a choice. And what you can see is that we've provided a number of data points: risk, return, Sharpe ratios over time. The real power of the tool, though, comes in the ability to select different economic cycles or different market shocks. If you select a specific time period and you scroll down, what you'll see is that time period highlighted on the chart, and you'll see the risk and return information updated. For any period that you select that's greater than a year, that risk data will be populated, and for all time periods, the return data is populated. If you select multiple time periods, the one that is highlighted is the one that is being presented in data in this table, and you can always verify that by double checking which dates are actually presented in those date tabs. Now, in addition to looking at market shocks and different market cycles, economic cycles are also incredibly important to factor-based investment strategies. And so you can select contractions and expansions over the last, the most recent history and identify performance during those time periods as well. Again, as long as the time period is greater than a year, you can see the risk data. And finally, all of these date ranges are fully customizable. So you can change that time period. Once you hit apply, it updates the risk and return. And for those of you for whom you still want ultimate customizability, you can click on that green bar in the middle and download the data. Now this is behind a login on our website. You have to log in as a financial professional, but what we hope that it will provide is opportunity to inform dialogue and develop investment thesis for factors based on different historical market shocks and economic cycles. Now, the second main challenge that we see clients facing is really portfolio construction. So if you think about strategies that might not fit a very clear Morningstar 9 style box method of diversification, or that are attempting to achieve very specific objectives like reducing risk, how does that translate into a typical conversation with a client about their risk tolerance? What we've built here is the Factor Builder tool, and on the left you can see a pie chart, and it's a pie chart of smart beta exposures. So in this case, they're all smart beta or factor-based strategies. As you just saw, you can slide that slider bar to adjust a risk tolerance, and the portfolio adjusts dynamically. And for even more customizability, you can click on the tab that will allow you to change the allocation to individual funds. So if you're already invested, for example, you can enter your allocation there, and you can expand to see all of the iShares Smart Beta offering in that suite. If you log in as a financial professional, you'll also get a view toward what historical performance would have been for this portfolio and for various asset classes and indexes over different time periods. So again, the idea here is to show you how smart beta funds can be combined together in a portfolio to achieve varying returns and varying levels of risk and risk-adjusted returns within a portfolio. And finally, if you scroll all the way down to the bottom, what you can see there is the basic characteristics that you'd be looking for in a fund. What is the country exposure? What are the sector exposures? The top holdings? And for fixed income, what is the credit exposure? So it gives you a very dynamic view of what this fund-of-funds portfolio would look like when constructed with all smart beta indexes. Now, finally, the last challenge that we really see clients facing is the ability to articulate the value add of these strategies that are not market calculated to their end clients. And that's really where a min-vol challenge comes into the fray. The minimum volatility has been the fastest growing area for investment in non-market calculated space, and it's the one for which we are asked most frequently from advisors, how do I explain this value add to my clients? The idea behind the min-vol challenge tool is that you can select your individual asset allocation and then view in dynamic space how a portfolio would change as you increase allocation to minimum volatility. So on this first page, what you can see is that you can change these slider bars to change your allocation to domestic, developed, international, emerging markets, equities, for example. And when you click next, it will take you to a view that allows you to dial up or down exposure to minimum volatility within each of the sleeves of the equity component of the portfolio. And as you can see, as you dial the minimum volatility exposure up, you can see the portfolio dynamically move west on this page, illustrating that value add of risk reduction that historically has come with a min-vol strategy. You can change time periods across the top and simply recustomize the screen. And what you're seeing at the bottom is an ability to hover over and look at what the upside and downside capture ratio of this hybrid portfolio is over time. And again, you can change it across all asset classes. So really the benefit of min-vol challenge is to understand how min-vol can benefit a portfolio in aggregate. And the best part about this tool is that you can click on a link to download a PDF report. It takes just a few seconds to generate that report, but what you get in the end is a PDF file that gives various investment characteristics of this portfolio that includes minimum volatility exposure. And the best part is that it's end client approved. So you can show this PDF and this view of the value add of min-vol to your end clients. So it gives you just another layer of information and collateral that you can use to have an educated conversation with your clients about the value add of smart beta products. So what we hope is that these three tools, the Factor Performance Chart, the Factor Builder Tool, and minvolchallenge.com will all allow you to have more well-educated, richer conversations with your clients about how these new and growing strategies can help benefit their portfolio construction. And I guess just to kind of close out my thoughts here is you can see smart beta investing is a hugely diverse landscape. There are a number of considerations that you need to think about before investing. The first is to identify the outcome you're trying to solve for. So understand whether that's reducing risk or enhancing returns or something else entirely. Second is to conduct appropriate due diligence on the managers and investment options in this space. And we would suggest that you leverage our handy checklist in that exercise. And finally, set up appropriate metrics for success to evaluate these strategies and really monitor your investments. So whether you're investing in multi-factor and evaluating returns, or you're investing in min-vol and managing and evaluating risk, I recommend you keep your eye on that prize and really tune out the rest of the noise in the market. That should give you greater success with implementing these strategies moving forward.
Holly, thank you very much for your time today and a wonderful presentation, a lot to cover. And we're certainly getting a few questions here from the audience, so I would remind you that we'd love for today's webinar to be interactive, so if you do have any questions, now would be the time to go ahead and submit them. I also want to remind everybody that should you be looking for CE credits, a replay, the slides, all of that information will be emailed to you tomorrow within 24 hours or so of the conclusion of today's webinar. So why don't we go ahead and open the Q&A up, Holly. I know in the early days of ETFs, there was always a debate about active and passive. Which one are you? Are you an active investor? Are you a passive investor? But how do you think about using smart beta alongside active and passive?
Yeah, so that's a great question because it's certainly not trying to compete with really either. I think there's a place in the portfolio for all three, and I've taken it back to the slide that really shows smart beta as a blend between active and passive. I think in a lot of cases, market exposure can make perfect sense and be perfectly appropriate for your client. The low-cost option. I think in all cases, you should choose the low-cost option for the exposure that is delivering precision in an investment outcome. So if the market is sufficient from a risk and return standpoint, beta makes a ton of sense. If you're starting from a beta portfolio and you want to dial up performance or down risk, then smart beta can be a fantastic add-on to that, again, in a low-cost fashion, focusing in this case specifically on factors. Now, smart beta tends to be long-only investments. They tend to be single asset class type investments. And so active managers really can add a ton of value add in long-short strategies, in strategies that aren't factor-focused, but true stock-picking strategies or sector rotation strategies, as an example. If you find a manager that is delivering on something other than the market exposure and something other than static factor exposure, then that's absolutely a place to employ active. So we see all three fitting together nicely in a portfolio alongside each other. All effectively we're saying is that for strategies that have historically tilted you toward style risk factors, and particularly equity style risk factors, smart beta is now a cheaper way to get that exposure. In every other place where you have used active management, there's still an incredibly strong value proposition for those funds in a portfolio alongside with market cap weighted index products.
Thank you for that. This next question goes back to more about the size of the smart beta market today and how much capacity do you think there are for new assets in that space?
Yeah, so the smart beta market today, we would peg smart beta ETFs at about $240 billion. So it's a decently sized market, but I think we need to put that in context with the broader investment landscape. So if the U.S. equity markets are, call it $20 to $25 trillion, really large market, active mutual funds in the, call it $4 to $5 trillion range, smart beta ETFs at $240 billion actually sounds quite small. So I would love to create, and I think I probably will at some point this summer, a chart or a graphic that illustrates those word graphics where what's largest and what's in the middle of the page is mentioned the most, right? I think if we did that on media, news, and rhetoric around investing, smart beta would be front and center. And certainly it's gathered a lot of assets, but these assets are small relative to the rest of the investment universe. And I think if we contrasted the assets with the rest of the investment universe, it would become very clear that there's a lot of noise in an area that is still small, though we believe rapidly growing. Now, second to that is, I think, oh, yeah, go ahead.
No, finish your answer. No, go please.
Yeah, so I think there's, it's small and yet still rapidly growing. I think when we think about assets flowing into the space, I'm often asked, how much capacity is there in a value strategy? For example, if everybody starts investing based on value screens and screening their portfolios, won't that alpha go away? And I think it's also important to recognize that a lot of the assets that are coming into smart beta today, we believe are coming from active strategies. Now, whether that's coming directly from active into smart beta or coming from passive, going from active into passive and then now back into smart beta, I think a lot of the investment concepts behind smart beta are based on things active managers have been using, and so assets in this space aren't necessarily net new to that type of screen or that investment strategy. So I think for those two reasons, we really think we're a long way away from even considering, what a fully saturated market might look like in factor-based investing.
Thank you very much. I actually have a very good question coming in right now. Given that min-vol reduces risk in a portfolio, would you recommend changing the ratio of stocks and bonds in a portfolio when using a minimum volatility strategy?
That's a fantastic question. And I would say that it depends entirely on what your stock and bond portfolio looks like today. And I say that not to not have a direct answer for you, but to recognize the fact that over the last few years, what we've seen in we have a portfolio consulting services team who evaluates portfolios for clients regularly. And over the thousands of funds that they have looked at, or fund of funds, what they have noticed is that in an environment where yields are quite low and have been low for some time, many managers have moved their fixed income allocation either to shorter duration or in a lot of cases to higher yielding areas of the fixed income market without fully realizing that higher yielding fixed income or higher yielding bonds have a lot of equity market risk embedded in them. And so what we've seen over the last, call it 8 months to a year, is that as equity market volatility, so equity markets were over the last few years historically low from a volatility standpoint relative to their long run average. And over the last year, we've seen an uptick in volatility, so periods of time where equity market volatility has looked more normal, which relative to the short investing horizon, directly prior to this period, it actually looks high. And so as we've seen volatility pick up in the market, we've seen a lot of clients concerned that their portfolios today are more volatile than they thought they were because they didn't realize how much equity market risk they've already taken on in their fixed income allocation. So for those clients, and really where a lot of conversations are happening today is, maybe you need a more aggressive fixed income allocation because you need yield in your portfolio, and MinVol can be a really great way to dial down the total portfolio equity market risk in light of changes that have been made in the fixed income allocation already. So I wouldn't necessarily say, increase your equity allocation because you're dialing down risk with MinVol. I think that it depends entirely on how you have changed your portfolio positioning, but you're thinking about the levers in the right way.
Thank you. And we seem to have quite a bit of focus here on the MinVol strategy from our audience as well. Our next question, products seem most appropriate, or these products seem most appropriate for clients an advisor believes will be unable to invest throughout a market cycle. Otherwise, wouldn't an investor be better off from a total risk-return basis not pursuing minimum volatility strategies?
So if I understand that correctly, I think what this question is getting at is, if you are not a long-term investor, then wouldn't the market be better because MinVol requires a period of time to effectively work in the portfolio? I'm often asked, if you think the markets are going to rally, shouldn't you not be in MinVol? Shouldn't you be in full beta market exposure or even something that is a higher beta than the market? What I would say to that is that intuition, I think, is absolutely correct to the extent that you are certain you can time the markets. And if we go back to that Dalbar study, or the data that shows that effectively investors have a really hard time timing the markets, what we know over time is that most investors will tend to underperform the market because they're not staying invested over the long run. And that's really another way of saying that many investors make that bad timing decision, or they make a really poor timing decision. And so if you can time MinVol versus the market, when to be risk on, when to be risk off appropriately, absolutely, these can give you another great tool. But what I would argue is that most people probably weren't expecting the volatility spike we saw in August. Most were probably not expecting the dramatic moves in the market that we saw in January and February. And if you can't forecast and call those moves, then MinVol can be a really dramatic tool to help you reduce and mitigate the downside that can come with a shock in the market like that.
Holly, thank you for that. And I think our next question touches on that again, but it seems to dovetail pretty nicely. Aren't buys in this space equal to market timing based on an outlook? If I'm a long-term investor, shouldn't I just buy and hold the market? Essentially, am I trying to time the market by purchasing one of these strategies at any given time?
Yeah, so I think that really goes back to this kind of view of bear and bull markets over time. So if you are a long-term investor, you likely will experience at some point a drawdown in the market, or a bear market, a cyclical bear market, and then you will experience a cyclical bull market. And when we've looked at data dating back to the 20s, what we have found is that in pretty much every bear-bull cycle, mitigating drawdowns with a lower than 100% participation in the market, meaning you're not participating in all of the drawdown, even with it meaning that you're not participating in all of the subsequent market rebound, has yielded better investment results. Now, certainly, if we entered a 20-year investment horizon where markets were steady and positively trending, MinVol's probably not going to capture all of that. But this really takes me back to kind of the main thesis behind MinVol. If your client is, in retirement, in the decumulation phase in their portfolio, nearing retirement, if a major market correction would be an incredible challenge for them to be able to meet their investment needs and goals over time, then MinVol can be really powerful. And I think it's where you try and use MinVol as a market timing tool versus an outcome-oriented, forward-looking, long-term investment tool that it becomes really challenging. So I would say, thinking about buying MinVol is about thinking about setting your portfolio up today for the long term versus thinking about when to time the entry point of that setup, because the eye is on the prize at the end of the long investment horizon.
Great, thank you. And we only have about 4 minutes or so left, but I think our last question here is one that will put you to the test here. For buy and hold in the core, is it MinVol or Multifactor?
Yes. So again, this is where I approach smart beta as outcome-oriented investment. The idea here is to understand what your client's main objectives are, and that's based on their personal risk and return targets. Does your client want to retire but doesn't have enough money and absolutely needs better returns than the market, or they're not going to hit that number? And are you, as their advisor, trying to outperform the market over time? Then multi-factor can be a really great plug at the core of a portfolio to give static exposure to factors that should drive better investment results over a full cycle. But if your client has enough money to retire and is concerned about drawdowns in the market or is particularly skittish, and I would even propose maybe will fire you if you lose them a lot of money in the next downturn, then keeping that client invested longer through a strategy like MinVol can make a lot of sense. So it's a very black and white question with a very gray answer, because like everything in setting up an advisory client's portfolio, it's all about that individual client's needs and their risk and return tolerance.
Absolutely. Well, Holly, I want to take this time here. We have just about 2 minutes left. One, to thank you for the excellent presentation today. There was a lot of material in there, a lot of helpful hints. I know it helped me really rethink how I kind of pictured smart beta and how to use it in a portfolio. Really, that outcomes result should really be what you're focusing on when you start to use these products. I want to remind the audience again that if you're looking for CE credits, if you're looking for a replay of today's webinar, if you want to get your hands on the slides, all of that information will be emailed to you within 24 hours of the conclusion of today's webinar. If we didn't get to your question, I apologize. We had many of them come in. As I said in the beginning, we do capture all these questions. We will get them over to Holly and her team over at BlackRock and iShares, and I'm sure they'll do their best to get in touch with you to get you an answer. So with that said, I want to thank everybody for joining us today. Look forward to having you join us again next week for our next webinar. And Holly, if there's any last thought you have about a minute or so, is there anything you'd want to leave the audience with?
No, I think, again, I'll take it back to think of the outcome, invest for the outcome, and evaluate strategies based on that outcome, and try and tune out the rest of the noise, because there's a lot of it in the market, and I think it obscures the true value add that smart beta can provide for you in constructing beautiful portfolios for your clients.
Well, again, thank you, Holly, and thank you to everyone who joined in. That concludes our webinar today, and we look forward to seeing you all again next week. Thank you.